Broadcast is now starting. All attendees are in listen-only mode.
Okay, we're just going to wait another minute here for our online attendees to come in. All right. Well, one more thing. Always something, right? I guess I will wear these. Okay, good morning. Welcome to our in-house audience here at the Treasurer's Office in Raleigh, North Carolina. And welcome to you, our online audience. We have quite a few of you logged in right now. For our online audience, just so you're aware, we're not going to take actual questions at this point. So we have everybody online muted, but there is a chat box located somewhere behind a little orange arrow in one of the four corners of your computer screen. Click on that, open that chat box, and we've got a couple of representatives available that will answer your questions immediately throughout the webinar. And then we will review those online questions with our audience here, and you'll be able to hear questions that they might have as well. So with all that in order, again, welcome. My name is Doug Mayer. I work for the Department of State Treasurer. I've been here for 14 years now as the educational outreach team in one capacity or another, so I may have spoken to some of you before. But we're going to try to sift our way through long-term disability. And one of the interesting things about long-term disability, in order to get there, you got to go through short-term disability. So we're going to do a quick review of the short-term disability program as well. So if you can silence your cell phones, and of course the disclaimer is this presentation is based on current legislation and is subject to change without notice. But we will let you know when it does. Today we're going to review the DIPNC, that's the Disability Income Plan of North Carolina program. We're going to review the short-term disability, preliminary long-term, extended short-term, and then we're going to get into the long-term disability process, the what we call a disability retirement, which is a DRET. You had to have been hired at some point prior to 1984 or 1982 in order for that program to be available. And then we'll have questions and comments again at the end. So we've got a couple of different types of service. Service is also very important in determining whether or not someone is eligible for benefits in the retirement system. So the first type of service we're going to talk about is called contributing membership. I got a seat way up front here. We got one in the corner there, and there's one in the second to the back on the left. I'm directing traffic in case anybody wondered. So creditable service is what we call, or contributing membership service is probably the most important. You need to have 5 years of this in order to become eligible to even apply or receive short or long-term disability benefits. You also need 5 years of contributing service in order to retire, either early at age 60 or unreduced at age 65. And you need 5 years of contributing membership service in order to make service purchases. So this is one of the most important. A lot of people refer to this as hard time, where they've actually come to work and received a paycheck for that service. I get a lot of calls from new people that join, say, maybe a local agency. They call up and say, hey, somebody took 6% of my paycheck, and I say, well, where do you work? And they say, I just got hired on at City of Raleigh. And then I'll say, well, great, you're a member of one of the 5th best retirement plans on the planet. We're the 5th highly or most adequately funded in the top 20 in size of retirement plans of this type. So we've got enough money to pay all of our retirees and people that retire in the future monthly benefits for the rest of their life. And the person on the other end of the phone goes, well, I don't care. I want my contributions back. And they'll say, well, how do I do that? How do I stop this? And I simply tell them that they get to go find a job somewhere else, because the contributing membership is set by state law. It is a requirement. For teacher and state, you work in a position 30 hours or more, 9 months or more out of a year, you're a member, whether you want to be or not. We're also going to talk about non-contributory service. I'll go into a little detail here, and that way if we come to another slide that has that specifically, we'll just skip it and move right on. But non-contributory service is where you get credit that counts for retirement benefits, but you don't pay for it. So an example might be free military. We have maybe a member who's part of the Guard or Reserve. They get called up to active duty. When they come back to employment, us, the employers, put that service back into their account by actually paying their contributions. They don't pay the salary they get from whatever their service, but the contributions are paid by the employer, and that, of course, counts towards non-contributory service. Now, another thing with this disability income plan, when a member is in receipt of benefits, they're receiving non-contributory service for every month they receive a benefit. Because what it does, we pay them until such time as they become eligible for an unreduced retirement at some point in the future. So all of this credit keeps adding up until somebody would be actually eligible to retire, and then they convert to a service retirement at that point. Welcome. And then again, we can purchase service. This would be also considered creditable service. It's not free. The member pays for it. It's full actuarial cost, so it can be very expensive. And then we sum up all of this service to determine when a member is eligible to retire or convert. So the disability income plan is made up of short-term, preliminary, long-term, extended short-term, long-term, paid by RSD, or the Retirement Systems Division, the retirement system itself, the same with extended short-term. And then this state disability, this does a projection of service till a member is age 65, and then they get a modified retirement benefit, versus the disability income plan, which is a sick pay plan. Disability income recipients receive W-2s. Someone on a service or state disability retirement would get a 1099. So we provide monthly replacement income for short-term, extended short-term, long-term benefits when you become disabled and are a permanent employee. So the program is meant to pay benefits to teacher and state employee retirement system members and ORP. This is what we call optional retirement. They are members of the teacher and state employees retirement system, but they're working in community colleges, UNC, etc. They might be doctors at UNC Medical Hospital, but that's called the optional retirement program. They don't actually get retirement benefits when they retire. Their program is just portable. So all of their 6% contribution and all of the employer contribution goes right into an account that they own, and they can just pick up and leave and take it with them at any point in the future, provided they stuck around for 5 years. That's the magic number. So short term is paid for up to 365 days following a 60-day waiting period. Extended short term can extend for another year, another 365-day period. In order to get extended short term, you cannot be eligible for long term. So extended short term, this person would still be, say, total temporary as far as a disability classification versus total permanent. Total permanent, they go right into long term. They also would then apply for Social Security, but we'll talk about that later. So after your short-term and potentially extended short-term period is exhausted, the member applies for long-term benefits, and then we just pick up from there. So in order to get short-term, now we're back into review, the member has to have at least 1 year of service. They'll get benefits for 365 days if the disability continues and it has not transformed itself to total permanent. They would be eligible for extended long-term for an additional, or extended short-term for an additional 365 days. But when that second year is over, they're done because they have not had 5 years of membership service. They get the short-term benefit after 1 year of service, but will never roll on into long-term. They need to be determined to be mentally or physically disabled in order to perform their job based on their hire, their qualifications, their duties. This is not the same definition as Social Security. This is called own occupation, where you can't do what you do, you're disabled, versus any occupation, which is if you can stand on a box and flip burgers at McDonald's, you're not disabled. So again, big difference, and that's why there's some disconnect with people who are on long-term applying for Social Security, because again, they might not exactly be looking at the same things in order to determine whether or not you're disabled. Another important fact is the disability must have occurred while you were an employee. If you had a specific disability before you were hired, and then decided you couldn't work anymore and applied for disability, you will not receive benefits for the disability you had before you were an employee. Also, if the member is out of service. Now, if you're a teacher and you're on summer break and you break your neck or whatever happens, you're covered, because this carries through between what we call breaks in service and contract years. But you're out of work or left your job and you're in South Africa somewhere and you fall off a bridge, you're not covered. unless you were specifically on a leave of absence receiving vacation pay, annual leave payout, in pay status. So pay status is also a very important factor of the disability income plan, determining who's eligible. Yes.
In reference to if they was out of state, or if you have a teacher that have a 10-month contract and then they get hurt while they're out of work.
Right. If they have assumed a new contract, they're covered. That's in service.
So they get hurt while
they're on summer break, whatever, they're still eligible. Right. But if they specifically terminated, let's say they worked at Wake and terminated in hopes that they're going to maybe go work in Alamance or something next year. But before they apply or sign a new contract, they're out of the system. Right. But if they have signed a new contract, even though it's end of June and school doesn't start till August 12, they would still be eligible because they're considered in service or pay status. Application for short-term disability must be completed no later than 1 year after the end of the 60-day waiting period. This is new. This became effective, I believe, last year on some 2017 legislation. There used to be no what was called statute of limitations for applying for short term. So somebody could, technically have been disabled while employed, and then whatever for 4 or 5 years later finally decides they're actually disabled and then applies for short term, and then the short term period leads to the long term, etc. This has been, the two now coincide, so that the short-term period begins whether or not you're receiving benefits. You could be getting workers' comp. You want to apply for it anyways, so that the two run concurrently. DPS does salary continuation. Anybody from DPS in here? Salary continuation. So over that potential 2-year period, part of that is short-term. They work together, they coincide. Benefits paid at the same time. One offsets the other, so you don't get 2 checks, but as far as the process itself, it's running concurrently. In order that, when this rule became effective, in order for that member to be eligible to go into long-term, that short-term application will have had to have been made. Whether or not they received any benefits is based on what their income is from other sources, but the actual benefit timeline does run concurrently with other illnesses, workers' comp, settlements, those types of things, and salary continuation. The term is salary continuation is paid in lieu of, but does run concurrently with the short-term disability period. Well, with all of that in mind, let's go to the next one. Okay, now here, a member can apply for short-term. Let's say they're 65. They get hurt maybe a month before they go out for retirement. They can still apply for short-term, even though that only 1 month of benefit would carry them beyond unreduced retirement eligibility. They can stay on that for a full year. If they are not permanently total, but total temporary, they could even go into extended short term and receive additional years of creditable service for each of those periods, receive 50% of their actual gross salary versus the formula retirement benefit, and then after that period is over, then they convert immediately to service retirement, but now they're like 67. So again, that can happen. We would look to see what is best in the best interest of the member. Because now remember, with our retirement system, we're paying a benefit based on a formula determined by salary, service, and then our little multiplication factor. So typically a member, even with 30 years of service, is only getting 55% of their income. So if they got less than 30, half of their income to start with is probably going to be a better option for them until such time as they would convert to a service retirement, which could be a lower amount in that case. Once all the eligibility requirements are satisfied for short term, then we begin a 60-day waiting period. Well, the conclusion of the 60-day waiting period is when the benefit begins. These are benefits administered and paid for by the employer. Now, we can help you. We'll rent you our medical board should you need help determining disability, making the determination. But as far as the administration and paying the actual benefit, that's on the employer. They do that. Now, anybody who started short term last month, July 1, there is no longer a reimbursement for that second 6 months of short term. That has been eliminated. That was also part of the Omnibus Consolidated Budget Act of 2017, if I'm not mistaken. But again, that does happen. So monthly benefit is 50% of 1/12 of the annual benefit. There is a little factor in there for including longevity and using all those other calculations, but it is gross salary at the time of disability. There may or may not be cost of living increases for short-term or extended short-term or even long-term benefits going forward. Those are dealt with separately in legislative issues as they come in the budget process. This benefit is up to a maximum of $3,000 per month, regardless of how much salary the person made. Short term, maximum $3,000, it stops. If there was a cost of living effect that would increase the member's potential benefit, they're still getting $3,000. It's the cap. The cap never changes.
And 3,000 is the cap, even including longevity, correct?
That is absolutely correct. Right. The question was, would longevity be paid in addition to that? And absolutely not. It is the cap. Question?
So I'm struggling with the first 60-day waiting period.
Mhm.
So I have an employee that she came to work, she had a heart attack in May. So she came back to work for a week. She had another heart attack. So she's out of doing. So the 60-day waiting period stopped when she came back to work. Never start back. You start over or how does that?
Okay, the question was if I had a member who went out on a disability due to a heart attack, got better, came back to work, and then had another heart attack and went out again. What do we do? Well, there's two issues. One is the continuation of the original disability in a return to work trial. It's called trial rehabilitation. And I believe we're going to be talking about that in a little more detail coming up. But if the trial rehab exceeds 40 days, then they would start a new disability. Assuming that the two are related, heart attack, sound pretty similar. But again, we'll let the medical board sort all that out. So theoretically, if the 40 days hadn't lapsed, this person would just go right back on to short-term and not incur a new 60-day waiting period. Okay, that requirement would be eliminated or waived. Preliminary long-term. This sounds like, okay, I fill out this form, the doctor or the med board approves it, I just get to cruise right on into long-term. Absolutely not. Preliminary long-term only overrides the monthly certification form 703. So if again, you're determined preliminary long-term, that means that your disability is expected to continue until at least the end of short-term. We will waive the physician certification 703 that we normally receive on a monthly benefit or a monthly time frame. Now, one of the big issues with this is when they eventually do the 7 or 701, whichever, to apply for long-term, we need a current 703 anyways. So then they go, oh, well, we sent you that one. Well, that one's more than 6 months old because they've been on prelim long-term. We can't take it. So then there's a delay. Somebody's got to go back to the doctor, all of that. So we just need to make sure forms are current in that process. And of course, we're going to go through that in more detail coming up. Again, they still need to complete the form for earnings because there is an ongoing monthly earnings offset if they're, and that's from any employer, that would, it's not overridden by the preliminary long-term. Earnings are always current. And then, of course, it does not present approval for disability long-term benefits. Okay, here's the package to put somebody on short-term. We got a 701 requesting the benefit, the 700. This is the employer's information. Job description, of course, provided by the employer. Form 703, reporting earnings for short-term and medical report for eligibility. And then the 7A is the actual medical report. This is the full diagnosis, everything that may or may not determine whether or not this member is disabled. And then this is reviewed for preliminary and long-term by the medical board to determine whether or not they're eligible. Again, back to short-term, your determination can be made by you as to disabled, not disabled, or the determination can be made by the medical board. Yes?
For what reason would a employer decide that they would make the determination?
The question is, why would the employer not want to make the determination?
Yeah, why would they not use the medical board?
Oh, why would they?
Themselves?
Okay. I know the answer to the other way around, but I don't know that I know the answer to that. Whether or not the employer determines whether this person is disabled or not is their right. They can do that. They don't, and that's typically a quicker process. But again, you're paying the bill, right? Because the employer is ultimately administering the short-term disability payments and process, including determination. If you want us to make the determination, there's usually a bit of a lag, time lag, because there are some backlogs occasionally, depending on the type of disability specifically, that might delay the determination of whether or not someone is disabled. So if that was the case, then the employer could commence the benefit anyways.
So if the employer says, you know what, we're not going to use the state office, we're going to take these 2 forms and we're going to make the determination 2 or 3 forms internally, could the employee then send those documents to the state office to override our internal decision?
In the instance where a negative decision was made by an employer, no, you're not disabled, they would have every right to forward that information to the retirement system. It goes to the medical board. If the medical board then decides, yes, you are, they are disabled,
Then we have to pay.
then you got to pay.
Start with medical.
Absolutely. Right. So again, there could be an extra step there. Okay, Form 701, requesting short-term benefits through the disability income plan, completed by the employer. 703, medical report for eligibility review. We need to complete this every 30 days unless, of course, you're approved for a prelim. 703 needs to be provided to the employer every 30 days to ensure that the disability remained the same. And the member should supply the 703 for monthly earnings. Employer may request a 7A medical report from the member along with all supporting medical documentation every 6 months or within 6 months. Okay, either the member or the employer may request determination of medical disability, here it is, by submitting a 701, requesting short-term benefits through the disability income plan. There are going to be 3 outcomes. 1 is you're approved, 2 is you're rejected, 3 is we need more information. The medical stuff, 7A medical packs that come in are reviewed by a medical professional before they go to the board, just to get some little check for accuracy, and they're not making a decision. They're just looking to make sure there's enough documentation there to present to the board, and the applications are in and current and everything is up to date. So that little pre-approval, then they send it to the board, and then, of course, one of 3 things. Request for additional medical documentation is probably happening more often than approval or rejection at that point. But again, it's all part of how we pay for health care these days and benefits through a finite asset from a state-funded governmental agency. So bear with us as we go through that process. We're going to send out the letter. If there is a rejection letter, the member does have 90 days to submit additional medical information, or the additional information if that was what the request specifically asked for. There's a thing called a functional capacity exam. It's not covered under Blue Cross and Blue Shield, and we're not going to pay for it at the retirement system. So every now and then there are some oddball types of tests or certification that might be necessarily paid for by the member themselves. And again, that's just how disability works. If the information is not received within 90 days, we cancel the application. They got to start over based on a disability that occurred while they were employee or while exhausting leave. Benefits are payable for after the conclusion of the waiting period, but do not exceed 365 days. The death benefit, should they die while in short term, is payable while the member's in receipt of short-term disability benefits, because they are still an employee. They have not terminated employment.
I actually had 3 employees that were non-renewed, and applied for short-term disability and were approved by the state. So they weren't actual employees of our school, and we were paying their short-term disability because they somehow proved in their documentation that they became disabled in the course of employment. So would they still be, well, we wouldn't pay the death benefit, that would be paid by your office, but would they still be eligible for the death benefit in that instance?
Yeah, the question was, are they still eligible for the death benefit based on even the hint of, well, we weren't going to hire them back anyways, but then they applied for a short-term disability and were approved. If they were approved, that means the disability did occur while they were an employee, so that is a right that they have retained, having at least 1 year of membership service. So yeah, that would happen. It could happen. Right.
They've all done well, so.
Fantastic. Okay. And then the benefits are paid by the retirement system. You're simply paying the monthly benefit. Did I see another hand, another question? Okay. Okay, the employer will pay the full month short-term benefit even if that results in payments exceeding 365 days, because the payment's based on a full month. It's actually fixed with the long term, either the remainder of a month or whatever, or the first of the following month after that 365-day waiting period. So, options for voluntarily ceasing short term. The member could retire. They would terminate employment, send in a 6, just like they would had they not been on short term, and then they're done. You'll pay the last full month of short term, and then they go to retirement. So this would be their decision. A member could get a refund. So they can't live on 50% of whatever. They need their full refund of all their creditable service because they want to get one check and go do something. It better be good, because when you get a refund, you are no longer a member of this retirement system. There is no future. What if you eventually get to 65 benefit? There is no future health insurance. There's nothing. It is a complete severance of all rights associated with the retirement system, period. One check, you're done. Don't call us back. You're no longer a member.
Do we get notification of that?
You would probably, as the question is, do we get a notification of a refund of contributions? Yes, there is an employer certification. You would have to, again, go through the termination and then certify that they have, in fact, terminated employment. 60 days after termination, we send them a check. One check, right. Or they could get better and come back to work. Now, they don't have to actually come back to work for you. They could go to any other state agency. They could go to work in local government, which is a different retirement system altogether. But then their short-term benefit would cease because they've exceeded their earning capability, which is capped throughout the program. So yeah, all of this stuff would allow a member to terminate short-term disability. It's a little more difficult when you're on long-term. I mentioned about the disability being temporary, and again, we'll just go through this. You'll have it for notes. I'll send you a full-size, full-sheet version as an email attachment, so you'll have this for reference material going forward. There is also a disability employer handbook available online that's going to duplicate a lot of this material. So some of these references, or all of these references, are available for you should you need them. So we're talking about how much it is, how long it's paid, the cap. So that's reference. First day of extended short term is the last day of regular short term. No new waiting period. And again, you could be approved for up to an additional 365, but that's only if the disability is temporary. Extended short term, more forms, 704, 701, 700. Job description, these you've already submitted. You're just going to send copies back in for whatever reason, because we probably either lost or don't want to look up the ones that we had. No, we want to make sure everything is current. But even if you send us copies of the documents you sent us the first time already, we're assuming you looked at them and made sure they're correct. So that's why we request them a second time. The 703, of course, the earnings and the medical report. 7A, this is what needs to be current. It needs to have, you have to have physically seen the physician that is determining your disability within the last 6 months. So if you've got the old one from 8 months ago, we're going to say, yay, thanks for sending the stuff, and then do nothing other than send the member a letter that says, send us a new one or a current one. And then that's just going to cause terrific delays in benefit payment and processing, because we're not even going to advance them to the medical board if there are issues with dates on forms and how long they have been since they've seen a doctor. 711, again, if your disability occurred prior to July 1, 2019, we'll still reimburse the payments and health insurance. That's the 711 and 714. Yeah, 711 is determining benefits. That's your pay cycle sheet. 714 is what you do after the fact for reimbursement. Okay, in the event that the member chose refund of contributions, again, this is review. Everything stops, no longer disabled, and they got to complete the Form 5. Form 5 does require an employer certification, so you'll know. And then, of course, they can retire. They got to complete the Form 6. They can do that even while they're receiving short-term disability benefits. The application can begin, or the process can begin 120 days before their actual retirement date. They would receive service provided you send us a 714 for all the period of time that they were on short-term up until their actual retirement date. If we don't get a 714, whether we're going to reimburse the employer or not, there is no service, because that's the document that determines how much service, creditable service, is added back to the member's account before they go to long-term or before they retire. Okay, and then there's also a waiver, which is the employee signing off stating that they no longer want to pursue or receive disability benefits. So they actually have to sign off on that. Termination, we'll stop it if they return to contributing membership, if they consistently exceed earnings, if the med board rejects them. There could be periodical medical board review. If they fail a review, we're going to reject them. The member can choose to terminate, and then the doctor on his 703 or 7A figures out they're no longer disabled, would terminate the benefit. So health coverage, you need to have 5 years of membership, contributing membership service, as of the date of short disability benefits in order for the health plan to be covered by the employer. If a member has less than 5 years at the beginning of the short-term disability, the member can have health insurance if they pay for it. It's kind of like a modified COBRA thing, but they're just paying you, the employer, and you're keeping them on your employer healthcare roll. It is not COBRA. I guess I shouldn't have said that. It's you, the employer, but the employee pays you to keep them on the program. If they have health or 5 years, then it's covered, even all the way into long term. We no longer provide retroactive coverage for health insurance. So again, you've got a member on short term, you pay, 365 days later, transfer to or transition to long term. Well, if the 7A is out of date, or maybe the doctor doesn't want to sign a new one, or he's saying, well, if you lost 40 pounds, you wouldn't be whatever. These things happen. If it's 3 more months before they actually get approved again for long term, the benefit payment is paid back to when it began, but the health insurance would start the first of the following month. So part of this, I guess, as how employers can help disability recipients is to kind of prepare some of this paperwork, or get them in, or have some kind of contact during the process, like a month or 2 before, instead of the day out for well, my check stopped, what do I do? We get a lot of that. I know they haven't been there for a year now, and depending on what other issues they might have, you might not want them to come back, but I think it would be part of our responsibility to help this be a smooth transaction, or at least as smooth as possible. Okay, if the employee's short-term coverage ends before extended short-term has been improved, because again, this requires the approval process now, there could be a gap. This is different. This is COBRA, because they've actually had an employer plan terminate and they have no health insurance. So this would be COBRA. It's still, I guess, done through you, different process. Similar premiums based on the employer cost. Okay, now we're moving into long term. Is it time to take a short break, or shall we continue, since we're kind of shifting gears now? Continue. You got to speak up or I'm moving on. I'll tell you that in case I offer this next time. So, long term, you need to have 5 years of contributing membership service, period. You can't buy it. Your sick leave ain't gonna get you there. It is physical. You were in the building. Well, you could have been on vacation. You could be burning annual leave. you actually could have maybe been sick for a month or two and receiving sick leave. But that 5-year period of whatever combination of that membership service is the first, foremost, and initial requirement for long term. Yes.
What if they have a break in service, so maybe they go to state government and get back, and, you know,
Okay. The question is, if they had a break in service, we don't hold that against them. We skip over the zeros, is what I call it. So they would still, if they worked for 2, took 2 off, they'd have to work 3 more to get 5. Because we don't count breaks. We don't count out of service for anything other than maybe age. Because you are as old as you thought you were the first of the month following your birthday. Right. Okay. Transferred service. This would be, say they got local service and they transferred it into teacher and state. Well, if they did that before they were disabled, they might be able to use that to get to the 5 years. But if they got 2 separate accounts, there is no reciprocity between separate retirement accounts, even though they're all state of North Carolina, for Disability Income Plan of North Carolina. Question.
Are there any negative implications for the employee in transferring their local government to their state?
The question is there any negative issues with transferring local service into the state account? Well, in all cases, you probably wouldn't be able to give a definitive answer.
Right.
So each one would need to be reviewed for its particular circumstances, but I don't see any reason why in a situation like this specifically that it wouldn't be a bad idea. Well, other than you don't know ahead of time you're going to get disabled.
Right, right.
So I'm going to transfer my service because next week I'm going to be disabled. That might not work.
I was
But
trying to think, should I go ahead and say, hey, if you have other service, it'd be a good time to transfer it just in case X, Y, and Z. But I don't want to be caught
Right.
in the loop of promoting something that could have a negative impact on them by some other little case.
right, some of the other issues would be if they are completely separate. At some point in the future, the member could retire from this one while they're still working here
Right.
and get 2 checks. You know,
Right.
It depends on so many things we got no idea
Right.
what happened. So it's our thought is don't recommend anybody do anything until they have to.
There you go.
Right. Proceed as directed until apprehended, someone once told me. So there's some other things. You need to have membership service, the 5 years, has to have occurred within 96 calendar months prior to the conclusion of short-term disability. How many years is 96 months? 5 years is 60 months, right? Okay, so it's longer than 5 years. So somewhere in that roughly 8-year period, the 5 years of membership service had to have occurred. So there is some room for, I forgot to file, or this, that, or the other thing, in order for a member to still be eligible. You need to apply for long-term within 180 days of the end of short-term. Now, if you didn't do it ahead of time, it's not going to occur immediately at the transition, short-term to long-term. So that was the member's first mistake, but they could have up to 6 months to apply. But if they go beyond that 180 days, they can't apply for long-term. Question?
Yes. If somebody was on workers' comp and worked concurrently doing short-term, but they're getting in lieu of their salary, do they need a clincher in order to get long-term? We've come across this, that's why I'm asking.
Right. The question is, if a member is receiving workers' compensation, they're going to get a income offset because the workers' compensation, at least in short term, for full disability is greater than the 50% benefit, so they run concurrently. The same would be in effect with long-term, except now the long-term benefit is 65% of gross salary, where still potentially workers' comp might be 66, which would offset the DIPNC benefit, and they would run concurrently. So that could happen. When there is a clincher, the clincher is when a member legally terminates through settlement their rights to workers' compensation. So with a clincher, we use that document simply to stop the workers' comp offset. So then they would get the full worker comp benefit, or I mean DIPNC benefit at that point, but by that time it might be offset by Social Security or something else. We'll talk about that in more detail. But potentially, if you didn't apply, you were just cruising on workers' comp, I believe there's some other thing we can look up later in the general statute, North Carolina General Statute 106, no, 135-106. 135.106 is the general statute for long-term disability. And it has the disability begins on last day of employment, date doctor certified, end of exhaustion of leave, or there's something in there, I believe, about workers' comp. So that's where we're going to reference that.
The long and short was, they hadn't clinched yet.
Right.
And they're talking about, so we were like, did we submit long-term even though they haven't clinched?
Okay, so I guess the answer is no, they don't have to clinch to be eligible to apply and receive concurrently long-term benefits. To not apply, waiting for a clinch, would be a mistake.
The forms do tell you that they should have clinched. The forms that you have to complete when you're doing that application, you need to provide that clincher. I don't have any either, but because we were in, we proposing that.
Okay,
And that's something we went through with the workers' comp people. We're two different departments.
okay,
But the forms indicate that we needed that information. That's why we kept requesting it, and they were arguing with us that it wasn't necessary. So we were just trying to figure out which way.
okay. Annie, can you make a note for us to examine the clincher and provide a follow-up email to all of our participants with the correct answer? Thank you. Okay, long-term, you got to go through the medical board. There is no free pass, go. It's medical board determination, period. And again, 180 days after the conclusion of short term. Disability is continuous, has to be permanent, and incurred at the time of active employment. So now we're just reviewing. you must here terminate employment. So now part of the disability, long-term disability paperwork process is the termination of employment agreement. Teachers they got to have signed contracts or whatever, but it's just a form as far as the retirement system is concerned with. And at this point, you cannot be eligible to receive an unreduced retirement benefit. So if they're 65 already and they got to have 5 years to get to long-term, they're going to go to service retirement, not long-term. They could have done the extended and the short-term, but if they're applying for long-term and they're eligible for a unreduced 30 years of service, 60 with 25 years of service, or age 65 with 5, they do not go to long-term, they go right to service retirement. And not eligible to receive an unreduced benefit with the optional retirement program. So even though ORP, which is part of TSERS, they're still members of the Teacher and State Employees Retirement System, they can be disabled, they can receive DIPNC benefits, but when they turn 65, we just stop sending them checks. Or when they would become eligible for an unreduced retirement benefit. Because they got their benefit. It's in the bank already. It's just hopefully they didn't spend it all. Okay, now to do long term, you need a 704, a current 7A within 6 months, and all supporting medical documents current within the last 6 months. Okay, include copies of all the disability, short-term disability forms. 700, 701, 703, or multiple 703s, the 711, the 714, and the job description. So again, the whole packet you already sent us, you're just sending it back to us, along with the current 703. Okay, trial rehab, we talked about that briefly during short term. In long term, in short term, trial rehab is they go back to do the job they had. That was their job. 40 days, you're no longer disabled. Thing starts all over, new 60-day waiting period, everything. Question?
Sorry, are you sure it's 40 days? Because I thought it was like a week or two for the trial rehabilitation for.
We'll know in a minute.
Okay.
Long term might be 40 days. No, long term's even longer. Okay, I'll review that as well. I'll get you an answer at the break. So we can do trial rehab in long term. It's any job in the Teacher and State Employees Retirement System, any capacity. They are in what we call trial rehab. We're going to suspend their benefits. They need to earn at least the equivalent pay as to what they were earning before, but they are now a member again, not on DIPNC, because they're getting a check from an employer. The long-term trial rehab is 36 months. So if they go back and work for 2.5 years and they say, well, look, whatever, I'm still disabled, they can come back, stop that trial rehab, and come back onto the DIPNC program, provided they have not been full-time contributing member for more than 3 years. 36 months. So it is a much longer period. And then, of course, we got to send the file back to the medical board for recertification. Okay, salary during trial rehab must be equal to or greater. We already talked about that. Members unable to continue due to the same or a new disability, they may be entitled to restore their long-term benefit. To restore the long-term, the member needs to submit a current 7A, medical board, medical information. Trial rehab, less than 36 months, must be approved by the medical board. If approved, long-term benefit is reinstated. Greater than 36 months, any subsequent disability is treated as a new condition or new disability and requires a new waiting period, and the short term starts all over again. Long term, 65% of the gross salary, adjusted for all the stuff, longevity, etc., up to a maximum of $3,900 per month, no matter what. And it could be up to a minimum of $10. So if for some reason they're getting $3,900 and they apply for Social Security or are getting Social Security and workers' comp or whatever if they can, if the benefits they're receiving from other sources offset the disability income plan of North Carolina, even if they got $4,000 total, and I don't know how they would do that. If they got $4,000 total, that completely offsets the DIPNC and then some, but we're still going to give them a $10 benefit. The $10 benefit keeps their health insurance going because now they're currently in receipt of benefits. Now, there's other issues where they might get nothing if they have an overpayment, because they forgot to tell us about a, say, Social Security awards letter or something like that. So there's all sorts of issues with this program. They're good. Okay, benefits are reduced by monthly, temporary total, temporary partial, workers' comp, which is normally 66 2/3 paid by the employer. There's a Form 21 and a Form 60 that's provided by the Industrial Commission we use to determine the amount of the offset from workers' comp. Veterans Administration also is an offset if it's for the same disability. Because sometimes we'll see veterans' disabilities where they're like 70%, but it's 10% of this and 20% of that and 30% of something else until it adds up to 70. And then only that percentage of same disability is what we would use for that offset. Question?
Do payments such as benefits from supplemental insurance such as AFLAC, does that go against the offset funds?
Okay, the question is, would private supplemental disability income benefits offset DIPNC? The answer is no. Right. Yeah, we're doing veterans, workers' comp, Social Security, and of course excess earnings. Now, if you're getting Social Security from your husband who passed, because you're now 50 or older or whatever that criteria is, that doesn't count. Right, it's not your benefit. Question?
So I am now thinking about a veteran that, very important, that is going out on leave, and be out, for more than 60 days, and we give them 8 months for an employer. However, I do believe he is getting some type of disability benefit. He's not quite eligible for retirement yet, or the benefits are unreduced from it, so he would do
I do not believe there's a veterans offset for short-term. That's going to be in your handbook, right? But specifically for long-term, there would be. But again, if he's got a breakout, we'll find what we need. If not, we're going to, well, because typically the veterans disability benefit was something that was from before he even became an employee. So they could be completely separate and unrelated. And if that was the case, that would not offset. But if it is the same condition, it would. Only the similar condition. Social Security, again, it's the member's Social Security or even the member's hypothetical age 62 Social Security is an offset. And excess earnings also offsets. You can earn up to the amount, the difference between what you were earning before and what you're receiving as a benefit, I believe. That's in here somewhere. Okay, the member signs a 705, which outlines Social Security and other applicable offsets before the disability plan begins. So they're acknowledging in the beginning that their benefit could be offset by anything they receive from Social Security. So that's all part of the process. If they do get an awards notice at some point in the future, they need to send it to us so that we can immediately address that offset. If they haven't received Social Security, we're going to do a hypothetical offset 36 months after they began receiving long-term. So we're kind of giving them 3 years to get it together with Social Security. So if you're approved for Social Security, there's generally a overpayment because the Social Security awards is typically rewarded retroactively back to the date of disability. So they get a big check, take a trip, whatever. If there's nothing left to pay back that offset, then there's an overpayment. We're not going to cut them off. We'll put them on a payment plan. If the offset is $10 a month, we're going to keep the $10 until that entire overpayment is paid. But they're still getting their other benefits, so it's hopefully not like we're sending them to the poorhouse. Just how it works. Retirement system will notify the member of an overpayment. We'll arrange, send them a letter confirming the overpayment should they choose a payment arrangement. And then alternate payment arrangement requesters subject to approval. The Department of State Treasurer also has a fee intercept program where we get lottery winnings and state tax refunds before the member does, if there is any kind of overpayment. Social Security offset is adjusted if there's an increase. So in December, our benefit would be adjusted based on the cost of living for Social Security. More offsets. Here's the 36-month hypothetical Social Security amount. So, you know, a lot of people look at this and they say, okay, well, I got 36 months to get my life in order. Well, if you're 61, you don't have 36 months. You got 1 year because the age 62 offset will supersede the hypothetical 36-month offset. So we're going to offset that benefit regardless. either 36 months after the member began receiving long-term benefits, but no later than age 62. So both of those could affect the benefit. We'll send them a letter 120 days before that offset occurs, telling them what their potential benefits will be going forward. If they had less than 5 years of service, and write this down, July 31, 2007, if they had less than 5 years of contributing membership service as of July 31st, 2007, but then who otherwise meets the requirement for long-term disability on or after August 1st, 2007, we're going to simply suspend their benefit at 36 months. Now, if they're 61, we're going to do the offset at 62, but then at 36 months, it's over. Suspended. After 36 months, no further benefits from DIPNC are payable unless the member has been approved and is in receipt of primary Social Security disability benefits. Now, okay, this is jumping around. I think I'm missing a slide. Right, so if the member at some point in the future, after this 36-month thing, after they were suspended, because they didn't have 5 years of service as of July 31, 07, if they get approved for Social Security in the future, we will put them back on DIPNC, Disability Income Plan. And then the one will offset the other so they don't get any more money, but they'll get health insurance. All of that other stuff that comes with that program. Okay, so now let's take a break before we go back into other sort of related topics. Good enough? Let's take 15 minutes. Does anybody have the time? 10:21. So 30, 10, 20, 36 will commence. Sound like a plan?
Yes.
Fantastic. 36. No. Then she can ask the question.
Right.
Have you know whether it's, that's the thing is. I did. If somebody is on short term and we're doing concurrently, so in lieu of they're getting a workers' comp pay, and now they're gonna apply for long term, do they need to submit a clincher in order to get long term?
Okay, so they, going straight from short term to long term. But they clinch their,
They have not. So that's what our question is.
Yeah, okay. If
But on the
they-
form, it asks.
if they have not clinched, um, the workman's comp, when they go into long-term, then your paperwork is going to indicate to us that they weren't a workman's comp. So we're going to question them about workman's comp.
And it'll be on their form.
Yeah, and if your form says that they have not clinched, then yes, we're going to offset for the workers' comp. I think it's 55%. That workers' comp is going to be offset. So if
They
they
didn't
long
have to
term,
clinch. But he was just saying that they didn't have to clinch.
no, they don't. People, but lots of people are on long term disability and they have not clinched. Some people, don't clinch until after long term disability. Some people clinch during long term disability, but either way, we are offsetting them, and they still, even sometimes people have real low payments to us. But the clincher, they just once they're working industrial commissioner, sets their way stuff is going to be for a clincher, then yes, they are to provide us a copy of the clincher.
I think the paperwork that we submitted is required, is requiring that information. Okay, so we're telling the workers, we need a clincher in order to proceed, because the paperwork is telling us what we have to follow.
But they don't have to, they can go into long term and still have not clinched. They don't have to clinch just because they're coming into long term. It's just that whenever they do clinch, they have to provide the clincher to us. If they come from short term or extended short term into long term, and they're still on workers' comp, that's just an offset that we're going to do, for pay. But if we don't know, or if we're not aware of the workers' comp, and there was no offset, then that's the serious thing.
Oh, yeah, I mean, we know, on there it says, if I'm workers' comp, we always answer yes on that, but I guess we're concerned because we have many
Now,
costs.
the disability handbook that he was talking about, that is a, some handbook that's out there.
Is that the
So this,
is?
yeah, and it's
We
got,
printed
yeah,
it, we got it.
yeah, it's got a lot of good information.
We printed that, that's our Bible. That's what we go for.
Yeah, this lady here, she must have been an employer, she's had some good questions. But I think some of it she wasn't, listening, to him though. When he says, like, on the social security offset, it's the bill social security. And she was asking about the offset is somebody else's social security. It's got this bill social security, it's got that's not really so they don't offset.
Did you?
Yeah.
That was smart. Like have coffee. Oh, I. You don't care if I put water
So when they,
or we can get water.
there is a definition of the second for, because I don't know if the first one, although we had more in it, and I'll have to look back to the areas. Some of those girls that was in here, when I think they're our employees, there's a great room, they might take this.
Okay.
I think they have one on this one too.
Oh, I'm okay. Go ahead. Are you sure? Thank you, I'm sorry.
No, it's sorry, it's okay.
I do prefer room temperature.
Oh, okay.
Yeah, thank you.
Are you on mute on this one?
Uh-uh,
Did you find a break room?
no, but it's fine.
Yeah, there's one up here somewhere. One of y'all from Fremont College.
No.
Oh, this way.
Oh, to break room, is there water and stuff available?
They have a vending machine.
Oh, they do?
So you go out, you go out the door and make a left, is through those doors.
Okay, thank you.
So where are you from?
Durham Public Schools, how great! Oh my gosh, you guys are doing so many new things there, especially with retirement. They're doing, presentations now and training.
Yeah, that's us, we're the ones doing it.
I gotcha.
We're the ones doing it, we're going to all the schools, all 54 schools.
Are you really?
Wow. They're coming to us for training and
When they're meeting at the staff development center, talking to our employees.
They
which is
are.
good.
Yeah, and that's, you guys are doing it quarterly now, which I think is great. You guys are big, you're a big system. You said 54 schools? Yeah, so, it's a great outreach, it's a tool that's great here. I think your consultant has been more helpful getting some things coordinated there too. So,
And we're trying to do cases with names of people.
I understand. I really do. I really do. It's just stuff that's like personal stuff. We're real fortunate. Yannick, Doug, and I, we all get to talk to parents here. And it's a hard thing because they're really anxious about retirement because they don't know what's going to happen. And so you talk to them about things and they get a little unnerved because they might not have thought of it, right? So yeah, you're absolutely right. Now, of course, for you guys too, even in terms of just like the other side of people, meaning when they first start, that's probably the next step. How do we help you guys to help the new people? If we get them to kind of get them settled, then by the time they get to retirement age, they're good, right? But if they don't do things from the beginning, some of those conversations are tough here. You know what I mean? In terms of, we might not have years of service, they might not have any kind of supplemental savings, so if we just get the new folks in, we'll just get settled.
That's what I say, like I started moving around from schools around college.
Yeah.
And if you didn't think about it, supplemental.
Do you think about it? Okay, well,
Yeah, I just gotta make sure that's right. Enough money in this paycheck is covered. $25 years later, school along the way. And if you started from the beginning.
Imagine, that's what I tell the young employees come in. I say, just start small, $10, $20, and then gradually increase. That will really
Won't miss it.
Exactly.
So we're not eating ramen noodles every night. Now, I know when you just get up to $40 school debt, you get all the other stuff, you never had real money before, so all of a sudden it's a hard thing to say, look, I want you to pay your future self. As I get older, I never pictured myself as older, and I never really thought about saving for when I'm older. As you get older, you start thinking that way a little bit more. But you lose the time factor. So you said like the new people and just get them in, $5, $10, $25.
And gradually go up with some of them, as your salary increase, you put a little there.
I'm always DPI. There's a lot of stuff going on with you guys. You got like new laws and everything.
Yeah.
So I'll be returning to work, hire people.
Yeah.
So we're trying to figure all that out. I'm sure that you are too. And then I just
Yeah, I would Department of Health.
oh, this is my favorite. Not that you're not my favorite. Get out of that one. We're all responsible, like for certain ones. You know what I mean? And so DHHS, I'm an honorary HBR.
Oh,
I used to work at DIPNC. Did you? So, yeah, we see you around. Okay, okay. Round table, and we've got a new guy. Oh, he's great, real knowledgeable.
Who was that person with DPI, though, do you know?
You know, I bet it's Jennifer Willis. I really do. And look, in your packet, there's like the all the retirement education counselor contact information. So yeah, if there's anything that you need, and I'll mention this too when I get a chance just to say a few pays. Her contact, it's in this packet. This one. This has got some of the supplemental stuff in it.
Because I know some of my employees have really reached out to me, I've been there like 2 months. But in reference to having someone come out and talk this in reference to former employees.
That'd be perfect. That would be perfect. Even when they change, you know how you change in terms of overall, you're still within government. I will tell you, certainly as employers, one of the biggest things, like these plans are all shared plans. Like you guys are different entities, but for the supplemental plans, all the same one. We get a lot of calls. I get a lot of calls from employers to say, well, this person is separating service for me, a local government, and they want their 401k. Okay, well, separating services, you know, and access to the money. Well, they're going directly to DPI or they're going directly to DHHS. And that's still government service. So unfortunately, you haven't separated. You know what I mean? We get that an awful lot. And I think it's just because Elders and TSERS are two separate entities, whereas 401k, same one. Yeah. For everybody, same one. So like there's certain kinds of criteria when it just comes to access. Certainly the disability discussion access.
So for Elders and TSERS, so is it the same thing? So would they have the option to be able to?
They would, because they wouldn't have separated service. Now, yeah, they left local government, but if they went straight to state government, which is absolutely fine, and this guy's going to get another pension benefit, how cool is that? But the answer is they didn't actually separate government service. Okay. So their pay status, not pay status, I think they were calling it pay status. We have them as either active, retired, terminated, right? Folks don't like terminated, they think it's for cause, and I'm like, no, it just means you're not really employed. But separating service is obviously an access for some folks. Now that's, when we talk about disability, they haven't separated service. So when I get disability calls, I'm really sad. So I'm more of a glass half full person, and typically I have to say, I'm so sorry, but you're not separated services, but I'm not working. I know, but you're still really employed, and I know you're really not. So it's good to know, because you're the ones that are sitting in front of folks, and they're going, well, I really need the extra funds because my medical bills are sure. So we'll talk about just resources.
We just tell people that that's still coming back to you.
Yeah, and that's a good thing. I mean, that is all good, you know what I mean? It's just, you know, what is the uses for retirement funds for non-retirement business, and they're really limited.
We also have training sessions with all the new hires, tell them it's wonderful to donate leave to people, but understand every 20 days you have left in your sick leave bank is going to help you later on down the road.
Now that's a good thing.
We always mention that.
Thank you so much. I just pop right down, you know. You're absolutely right, because of the value that it has to be in terms of credit service. It's a cool thing. I just
I'm trying to deter you from helping somebody. Write them a check. Just get a card. Don't give away the sick days. I'm gonna help you.
Swishing through.
Oh, it's been those grades.
Yeah. Not dealing with a certain situation yet. Push it through this.
Yeah, she's probably a communications person here at the Treasurer's office, and she knew guys were all employers, so she wanted to reach out to them and say, if there's things like in your retirement monitor, like the communications they put out for, did you want to see, like, you guys see more stuff about, I don't know, disability, or more stuff about changes in law, or more, you know, like what kind of stuff you want, so feel free to reach out to her.
The communication monitor, that just comes to administrators, or does that go to all members?
Is that something
No.
I should be forwarding to the people?
No, it is for employers only. Now, there is indeed a newsletter for participants or members, okay? Meeting them all, like I think one's like signature newsletter, this one, the one for you is monitor.
Okay, yes.
So it'll be a little bit higher level and a little bit more on the operational side, you know what I mean? For participants, it's usually like more stuff pertinent to, not maybe plan level, but more like them.
Okay.
But if you even have, obviously she communicates to participants too. Feel free to reach out to her. Hey, I've got this idea, maybe you can put more stuff in there about this. There's obviously so much that's in our inboxes, you know, wants to make sure that it's useful.
Yes, thank you very much.
Useful information is always good.
Yeah.
Did you enjoy your break? Did anybody have any questions on what we've covered so far? Okay, we'll pick up where we left off. Okay, exhaustion of leave. Exhaustion of leave during short term does not make the short term period any longer. So if for some reason somebody had a whole year of vacation or unused sick leave and they were exhausting that and still had a balance after short term, the transition happens short term into long term, and then they would simply have some left over. You can receive payouts for any part of a day in lieu of long-term benefits for that day. So if you only exhausted $10, that's all they get for that day. Lump sum payment for leave is treated as if the member had exhausted the leave in lieu. So if they didn't use any annual leave, had 30 days when long-term began, and you write them a check for 30 days, we're going to offset DIPNC for 30 days. So all benefits are in lieu of payouts. Any kind of payouts will not delay the beginning of the state health plan. Members are allowed to have earnings. They should contact the retirement system for their specific earnable allowance, and it's based on gross earnings from any source is part of their earnable allowance, not just from coming back to work at Teacher and State like an earnable allowance for a retiree. It is any earnings. Now, once the member can convert to service retirement from long-term at, say, age 65, then only earnings from the Teacher and State would be counted towards an earnable allowance as a retiree. So that in that respect, they'd be able to earn up to $31,360 in any year, or 50% of their highest 12-month salary indexed for inflation. If you exceed the earnable allowance, we do a dollar-for-dollar reduction in the benefit. It is offset. So here's a calculation of earnings. We've got their adjusted gross salary as an active employee, $2,200. They're getting long-term benefits, 65% of that $2,200. They would be able to earn $770, or up to the total of what they were earning before they went on disability. Excess earnings are actually reported annually on an SOI. And then, of course, if you're in receipt of Social Security benefits, then the earnable allowance is adjusted accordingly. Conversion to service, you must attain the age and/or service requirement for an unreduced retirement benefit. Again, unreduced retirement is age 65 with 5, age 60 with 25, or 30 years of creditable service, regardless of age. That conversion would then convert you to a service retirement based on the amount of creditable service you have at that time. That would include the non-contributory service for all the time you've been in receipt of short-term, extended short-term, and long-term disability benefits. The earnable allowance changes from ordinary income. There are no more offsets for Social Security once a member converts to service retirement. So any of the offsets for workers' comp, Social Security, or veterans benefits would no longer reduce their benefit. And again, we'll tell this member 120 days before their conversion date and provide estimates of what that new monthly benefit will be within 30 days of the conversion date. We do, as the medical board, periodically review a member's file to ensure they're still disabled. The medical board determines whether or not a member needs a medical re-exam. And if there is a requirement for a re-exam, we'll notify that member 60 days prior to the need for a re-exam. And then we might need updated information along the way. And of course, retirement system doesn't pay for re-examination costs or fees. Extended short-term, long-term taxation. This benefit is subject to North Carolina income tax, again, and federal. It is a modified sick pay plan. It is not a disability benefit for someone under the age of, say, 65. So 100% of this benefit, unless, of course, they were Bailey eligible, had 5 years of membership service on or before August 12, 1989, and never withdrew their contributions, they would not be subject to North Carolina. The payment is exempt from FICA. Any kind of leave payouts would be subject to FICA. That's the Social Security, unemployment, and other taxes related to that, 7.5% of their income. 7.5% paid by the employee or employer. And then contributions, the 6% contribution that we lose as a contribution to, as active employees to the retirement system, contributions are not deducted from disability income benefits or retirement benefits for that matter. Health coverage paid for the member, even in long-term, if they had 5 years of contributing membership service as of the date of short-term payments. There is still the traditional 70-30 and the 80-20. These are for members younger than age 65. Service transferred prior to the date of disability will not help a member qualify for coverage under the health plan. You need to have 5 years of membership service in the teacher and state employees retirement system to get health insurance. Extended short-term period, long-term begins between the 1st and the 14th of the month. Medical coverage begins the 1st of the following month. If the short-term or long-term period begins between the 15th and the 31st, coverage begins the 1st of the first after the 1st of the month after the first full month. So there'd be a month and a half, almost 2-month delay in coverage from the state health plan, depending on when they are approved. Okay, here's a scenario. Summer has 7 years of contributing membership service with the teacher and state employees retirement system. She's approved for extended short-term disability effective February 13, 2018. Is Summer eligible for the state health plan under the DIPNC? Yes. If so, will the effective date for her health, what would be the effective date under the DIPNC? March 1. Okay, Susan has, oh, it's given me the answer too soon. Susan has 4 years of contributing membership service and 3 years in local government that was transferred to her account prior to disability. She was approved for extended short term on February 22, 2018. Is Susan eligible for health insurance under the DIPNC? Given. When she converts to a service retirement, will the retirement system pay for her health insurance? No. Doesn't have 5 years of contributing service earned with the state. Transferred service from local government employees retirement system does not count for health insurance eligibility. Now, people hired on or after October 1, 2006 have an additional requirement to get state paid health insurance as a retiree. That's 0 or 5 years or more, you're eligible, but the member pays for 100% of the employer cost, plus any other copay they might get depending on which plan they chose. From 10 to 20 years, the state pays for half of the employer cost, and they pay for 100% of other costs. And then if they have 20 years or more of creditable service, the state will pay 100% of their employer cost for the state health insurance. To get to the 20-year, or the 10 for that matter, that transferred membership service from local would count. It counts for the 10 or the 20, it just doesn't count for the 5. The initial 5 has to be with the state. While in receipt of disability income plan in North Carolina, the death benefit remains in force. Highest 12 months out of the last 24 months of earned compensation, or $25,000 minimum up to a maximum of $50,000. ORP, optional retirement plan members in receipt of DIPNC are not covered by the death benefit. Disability income plan survivor alternate. If you're approved or your members are approved for DIPNC benefits, a member's benefit may be eligible for the survivor alternate benefit, presuming that disability recipient dies and they had at least 20 years of creditable service, regardless of their age. Now, the disability non-contributory service counts towards that 20 years. Unused sick leave, should they have any, does not. You can't use sick leave to get to a minimum requirement for survivor alternate benefit. If they're 60 years old and die and had at least 5 years of state contributing membership service, that beneficiary, provided they've named only one for the return of contributions, would be eligible for the survivor alternate benefit. Survivor alternate benefit is the survivor option of option 2, paid to that survivor as a monthly income for the rest of that survivor's lifetime, based on the salary and service that the member had at their death. So that kind of calculates a service retirement. The surviving beneficiary, if there's only one, can elect that benefit going forward to be paid for the rest of their life. They also have the option of the return of contributions, lump sum distribution. It's either or. If the member had named more than one beneficiary for the return of contributions, that benefit is simply split equally by those number of beneficiaries. The survivor alternate benefit is not available. Law enforcement, they qualify for a little earlier should they die while either in DIPNC or in active service. Right, you name only one principal. That's the Form 2C, 2RC. We got many different versions of that now. It's currently it's again a Form 2C, and that needs to be notarized. So if anybody's changing beneficiaries through you, there is a new form. It rolled out last year, and it requires notarization. It combines the death benefit and the return of contributions onto one form. All members can now designate beneficiaries in Orbit Self-Service regardless of their service. Used to be if you had 10 years or more, you had to use the form, but now anybody can do that. A beneficiary has to be living at the time of the member's death. Now, if the member lists a trust or the estate as the beneficiary, the trust or estate doesn't get survivor alternate benefit. That simply allows the return of contributions. And beneficiary may elect to either receive the lump sum or the lifetime income. If they take the lump sum and pay themselves what will pay them for the rest of their life, they'll run out of money in 4 years. So the lifetime income is a longer period, better benefit, but you just have to wait to get it. DIPNC became effective January 1, 1988 as the state's disability plan. Members vested prior to July 1, 1988 qualify for both disability plans. That's the state disability and DIPNC, either or. Again, the state disability is using a projection of service to the member's first unreduced retirement date, and then creating a modified service retirement that includes that projected service that begins to be paid to that member for the rest of their life. They've also got the choice of survivor options or maximum option. So there are pros and cons to each plan. If they were to qualify for both, we will send them information on both and estimates of benefits. To be eligible again for the state disability retirement, if they had 5 years of contributing membership service as of July 1, 1982, the service projection goes to age 65. So if this guy started at age 20, right out of high school, and already had 20 years or whatever, and became disabled, but had 5 years prior to 1982 date, we're going to project service up to age 65, which would be like 45 years to convert to that service retirement. And the benefit begins immediately upon the disability. If they had less than or didn't have 5 years in 82, but had it on July 1, 1988, then we will project service to the first unreduced. So with the guy that started work when he was 20, we would go to 30 and then just stop projecting. And then sick leave and all of that stuff becomes part of the projection. It's not added on top of at the end. And then if you had at least 5 years of contributing membership prior to July 1, 1985, it's the combination of the two, projected to 30 or 65, whichever comes first. So the procedure: in order to apply for disability, we need a Form 7, a Form 7A, the medical documentation, job description, proof of birth. That can be a birth certificate, a passport, or a driver's license. Do not submit original documents. will accept a copy of any of them. Now, if they were applying for a passport, of course, they got to send the originals off, but and hope they come back. We do not require original copies, just copies. Benefits are not paid retroactively. Okay, if you're approved, we'll do a comparison between the DIPNC and the disability retirement. The member decides, depending on which option he chooses, Form 7E. It's similar to the one for a service retirement. Disability will take into account if the member applied for and received short-term benefits. So there is, if they get short-term and then realize they're eligible for the disability service retirement versus disability income plan, because the benefit was bigger, we would do a quick offset and overpayment recovery of the amount that we may have paid them or you too much in short term. But typically it's a net win for the member if they qualify for service disability versus disability income plan. Survivor options for disability income retirees are different than survivor options for service retirees. They produce a lower benefit to begin with. Then, of course, the members or the beneficiary continues either 100% or 50%, depending on which option the member chose. And this is all figured out actuarially. Option 4 is not available for disability service retirement. So here's the formula. 1.82% of your average final compensation times your years and months of creditable service. And for the state disability retirement, that does include the projected service, either to age 65 or to the first unreduced. Okay, correction. Sick leave is added to service after the projection. So if they had 10 months of unused sick leave, we would do the projection to either first unreduced or age 65, depending on when they started service, and then add the sick leave on top at the end. So they would get a slightly larger benefit. Annual leave, longevity, all of that paid out as terminal leave is calculated as part of the last month's salary to determine an average final compensation. So if there were any payouts, that's taken care of in the AFC of a member's benefit. So now we got another example. We've got Jeff. He's using an age 65 projection for a state disability. He's born in 1957. He entered service in June of 1977 at 20 years. He retires January 1, 2021. He's got 101 sick days. Every 20 days equals 1 additional month of service. Whatever is left over after dividing by 20, provided it's at least 1 hour, adds an additional month. So that's where 101 equals 6 instead of 5, because the 1 day left over added an additional month of creditable service. This guy had 23.5833 years of service. That's 23 years and 7 months. Age 65 would be 45 years as of June 1, 2022. So 21.4167 is added, plus the 0.5, 6 months of sick leave is added to that. This guy would get a state disability retirement benefit based on 45.5 years of service. If an average final compensation was $35,000, his net monthly benefit would be $2,415.29. That's the maximum benefit paid to that member every month for the rest of his life. beginning in 2001. If we're using the first unreduced, this is had 5 years as of July 1, 88 versus 82, the sick leave is absorbed in the projection. It's part of the creditable service added. Any annual leave, prorated longevity, etc., is calculated in the average final compensation. Here's the example to the first unreduced. Date of birth 12/1/62, entered service 12/1/81, at 19 years of age, retired or became disabled for a state disability retirement, January 101, sick leave 101 days, actual service 19 and a month. So the sick leave is added to the 19.5833, and then it's then calculated to the first unreduced, which would be 30 years. So we're adding a disability projection of non-contributory service of 10 years and 5 months, 10.4167. So this member's benefit looks like this. He only gets $15.92 paid to him every month for the rest of his life. But the difference is 15 years of projection between $2,500 and $1,500. Disability retirement is not offset by Social Security, workers' compensation, or veterans benefits. We can still do re-exams even if they're on a service retirement or service disability. We'll notify that member 60 days prior to the re-exam. Taxation is the same, subject to federal and North Carolina, unless, of course, they had 5 years of service prior to August 12, 1989. Then they would only be subject to federal tax. They'd be state tax exempt. And there's no FICA on the retirement, no 6% contribution. Even on state disability, projected to first unreduced or to age 65, the member must send in a statement of income, SOI, because the earnings would still potentially create an offset. That needs to be returned by April 15. This also applies to DIPNC. Failure to respond may result in a suspension of benefits. If the material comes in after the date, after we've suspended, we will restore their benefit retroactively. However, health insurance will not be. Health insurance is not retroactive. Earnings cap. Contributing membership positions with TSERS, if you exceed the earning cap, the benefit ceases. That's when you come back to a contributing membership position in Teacher and State Employees Retirement System, the system they were on disability from. So if they come back and take a full-time position, the DIPNC benefit or the service retirement stops and it is not reinstated. If that member then subsequently retired, let's say the guy with 45 years, he would then retire on a normal service retirement based on his creditable service only, not including the 21.5-year disability projection. So they would lose that forecast non-contributory service related to the disability. If they go to a position that's not in Teacher and State, they're subject to the earnable allowance, and then it's non-contributing position in teacher and state employees retirement system. Part-time, temporary, interim, or contract. As long as that position itself, the job, does not require membership contributions, they can work there under the earnings cap. If they go to employment with any non-participating, any employer, local or private, where's the next sentence? They're subject to an earnable allowance until such time as they would have naturally attained the unreduced retirement age and service. Earnings from any employer are subject to the earnable allowance for a state disability retiree. Whether it's coming back to the same system, going into a different system, or any private employer. But once they convert based on age and service, so once that guy eventually got to age 65, then there is no earnings cap. Unless they come back to teacher and state, then that's forever. Okay, if the earnings is exceeded, the retirement system notifies the member. We can arrange for payment arrangements. And then, of course, if there's some kind of alternate payment arrangement, that would need to be approved by the retirement system. So here's the service earnable allowance. When they reach the age they'd been eligible without the disability for a service retirement, the disability retirement earnings restriction ceases. If they're below that age, it's 50% of the last year's salary, or $32,940. That's last year's number. It's $33,560 now. This is adjusted by Consumer Price Index and will notify the member of their service conversion retirement date. Death benefit, we talked about that. Highest 12 months out of the last 24. Minimum 50, maximum, or minimum 25, maximum 50. Optional benefit, state health plan, contributory death benefit. This is a $10,000 last expense pay, optional for all retirees. So again, the service disability retiree would be eligible for the contributory death benefit. It's a level premium determined by the member's age when they retire that never increases, and the death benefit itself never decreases. However, we do need to see the premium payment for the first 24 months before the full $10,000 benefit is paid. They can list anybody as a beneficiary. If they don't, it is their estate. Used to just be spouse, but now it can be anybody. And then there's voluntary dental, vision, and it's actually LifeLock that's available. State health plan, just a review, first hired prior to October 106, 5 years of Medicare or contributing membership service. They're eligible for the plan. The state pays the premium. When a member becomes eligible for Medicare, the member must elect both Parts A and Part B. The state health plan becomes secondary. Retirees in the state health plan do not need Part D of Medicare. The prescription stays. $10,000 contributory death benefit. They have 60 days to elect. Make 24 payments in order to receive the full benefit. If for any reason the retirement benefit is stopped, either they became a member again and we ceased their monthly benefit, they need to continue that benefit by paying their own monthly premium directly to the retirement system. If they don't, the coverage would lapse and they subsequently retire again, this would not be available. Pierce Dental and Vision. Once the member makes a payment election on their Form 7E, they will be eligible to elect dental and vision. These are through United Health. They're different programs than what they had as employees. Their employee option coverages ceased the day they terminated employment, unless they chose to do COBRA on those. These are different. They'll replace what they had. They're not the same, and they're starting over. So specifically with the dental, it's a tiered 3-year plan. So first year you get exams, second year you get some of your teeth fixed, and third year is the good stuff, or expensive. And the plan pays for up to 50% of the approved cost. Resources, benefit handbooks, frequently asked questions, these are all online. Benefit highlights, return to work policies. We've got a section in there for legislative updates as well. Online resources are also our retirement planning conferences, upcoming events. We've got reduction in force information. There's Orbit employer reporting information. The Orbit guide is on there, all 182 pages for employer reporting. The disability benefit welcome packets, they're just forms now that can be emailed. We don't mail those to anybody anymore. Disability benefits processing and training, that's available. There is a cut-up version of this presentation already under the employer tab online. So if you'd rather look at specific segments, you can just click on either one of those, or review this material or the Disability Employer Handbook. And then there's information on discontinued service retirements and also legislative updates. Employers do have access to Orbit. There's somebody in your organization that does the actual active employee payroll through Beacon, but Orbit access is available as well. Our contact information, online, myncretirement.com, email nc.retirement@nctreasurer.com, Orbit employer reporting issues, OER@nctreasurer.com, and we're even on Facebook. You know where our office is, 3200 at Atlantic Avenue, Raleigh, North Carolina. And then the phone number, 877-NC-SECURE. That's 877-627-3287. Now, at this point, I'm going to stop and see if we have any questions remaining on the disability income plan. Yes.
So you showed a slide that gave different handbooks and even potentially a link to tutorials on the site. Is there, I know you said that the reimbursable part ended for people disabled after 7/1/19. For persons that are reimbursable that were disabled last year, is there a tutorial to help us fill out that paperwork to get our money back as an institution?
I believe not, but the Form 714, which is the required document, has a couple of pages of instructions.
Form 714.
Form 714.
Okay.
Right, we use that to restore service and current reimbursed accounts for benefits paid and the state health plan premium. Okay, anyone else? Okay, for our webinar audience, I think I forgot to mention that the PowerPoint presentation is available in a PDF version in the handouts section just above the chat box. So you want to, in the next few minutes, pull that out, download it, and save it if you haven't already. So I'm going to review the online questions. Okay, we had a question about, does the person have to purchase disability insurance? No, the state health plan disability comes from employment. You can, however, purchase additional, which may supplement your income. Most of the supplemental private disability plans are offset by what you receive from Social Security or any other disability plan. So a member needs to look at that very carefully. Deadline to apply for the reimbursement, not necessarily, provided the member's disability was prior to July 1, 2019. Okay, we had a question about a member who would be on short-term whose health began to deteriorate. Of course, based on the medical assumptions by that attending physician, at that point you could apply for the preliminary long-term. We talked about return to work. Trial rehab is 36 months. So if you, again, come back to work in a position with any employer in the teacher and state employees retirement system, earning at least the equivalent to what you were earning before you went out on disability, you are considered to be in trial rehab. If that period of employment exceeds 36 months, the member would need to have a new disability event in order to be approved and receive disability income again. Someone asked if they get benefits from their husband's Social Security. That would not offset the DIPNC. Only the primary benefits received by the member. Okay, does the retirement earnable allowance count towards Social Security benefits? Yes. Social Security has their own offset once you're in receipt of early or Social Security disability, I do believe, based on ordinary or earned income. So the DIPNC is not earned, it's ordinary. So that's not part of Social Security's offset, but any earnings is part of the DIPNC offset and early Social Security. Early Social Security's is $17,000. For every $2 a member earns over that of earned income, they take $1 of their Social Security benefit back. Okay, enough of that. Let me get rid of this and pull up a second presentation for our next presenter. This is the supplemental plans. We won't keep you forever, just half of forever. There we go.
All right, thanks so much, Doug. All righty. Truly not forever, just another maybe 15 minutes or so. And this is really because in a discussion about disability, many times you have folks sitting right in front of you and they're going to ask you the question, well, what can I do with my 401k? What can I do with my 457? So I have a presentation, but jumping off points, I'll try to bring those back to our discussion today, okay, in terms of just the kinds of things that we would want to make sure that you feel comfortable with in terms of relaying information about the supplemental plans. So hello, webinar friends. Margaret Hendershot, and I'm a retirement education counselor with the 401k and the 457 retirement plans. I have a wonderful position. I am here at the treasurer's office talking to pre-retirees every day. So I can tell you all the things that they do well and some of the things that necessarily we would need to focus on. In terms of our presentation today, I think one of the things that we had talked about, let's just go right from the beginning, retirement plans by their very nature are very, very limited in terms of their uses outside of retirement. And that may sound really simple, right? You're thinking, well, yeah, retirement plans are for retirement, Margaret. But while in active service, members, participants are very limited in terms of what they can do with their money, right? Once they open an account, once they start contributing, and even if they stop contributing, there are very limited reasons as to why they'd be able to access their money while in service. And when I say in service, this means certainly it could be short-term disability, long-term disability, obviously active service as well. There's limited things. And so we're going to just point those out for you so that you kind of have an idea about what those are and what are some of the ramifications necessarily for your folks once they do indeed separate service, should they maybe not be eligible for avoiding a penalty and those types of things for withdrawal of their accounts should they separate service early due to disability. That's not changing the screen, is it? On the left, really?
You see the scroll bars and even.
What do you think, Doug? Is it you're not if you don't mind.
User error.
User error. Typically arrows work, but okay, so just your presence actually changed it?
There you go.
Well, now it's not changing here, but it is changing there. Webinar land, stand by. Just a technical glitch. I can certainly look at the screen as well because all our folks here can see the screen, so that's absolutely fine.
This is it.
Okay, that's absolutely fine. Thanks so much. All righty. So as retirement education counselors, you know that we tend to start with the end in mind when we talk to your participants about retirement. What's the end in mind? Like, how did they envision retirement? And I will tell you, in talking with over 6,000 retirees and pre-retirees last year, not everybody has a plan. Not everybody really has a plan. I think the biggest misconception, certainly to be able to share with you, is that there really is a confusion that once you attain eligibility for a pension benefit, hey, I've got my 30 years in, or hey, with my sick time, I'm going to be able to not have a reduced benefit. That's great. So you've gotten your pension benefit, right? But the misconception is that just because you're going to get a pension benefit, that you can actually live on that, As Doug had mentioned in his presentation in the beginning, typically as good as it is, and 45 states not as good as North Carolina, yay, because you're putting 6% of your pay in there too, right? So that's a good thing, but know that it is not designed to provide 100% of what we're making right now. It's not designed for that. The average person in the teachers and state employees retirement system covers 44% of their income at retirement. And that's because not everybody works till full benefit. We see a lot of folks come back to work, later in life as well. So it's not necessarily 30 years of service anymore, right? So 44%. Do you guys have an idea about how we determine readiness? How do we say that people are ready? Any idea about how much of your income you should replace? Webinar friends, just raise your hand. Any idea? It's more than 44%. We want them to have more than that. But what do you think? What do you think we say, hey, you are retirement ready? 60, good, 60. We got 60 as an answer. What do you think? 60? Do I hear 70, 70, 75, 75, 80, 85? For the most part, when we talk about readiness, financial experts recommend that we can replace 80% of our current income in retirement. Now, that precludes necessarily that the kids aren't living back home with you, right? I got an amen. Yeah. Also necessarily you might be caring for aging parents. That was our situation in terms of helping them out, whether that in time or money. So 80% is really just an average recommended amount. Now I want to let you know that you as individuals, meaning everybody here has their own subplan for the 401k and the 457, meaning it's all the same plan, but you at DPI is a little different with the number identifying you than DHHS, right? So every subplan has a readiness number. How cool is that, right? How cool is that? So you can actually know what your readiness number is. School system, what's your readiness number? We can take a look at that. How cool is that to know to start, right? How many of my folks are really on track to be able to replace 80% of my current income? We've got that information. Cool. In terms of necessarily what indeed are the kinds of tools available for not only members and employers, how many folks have actually heard of annual benefit statement or the MyNC retirement statement? Annual benefits. Okay, alrighty. Checkpoint 2 actually shows people if they are on track. Checkpoint 2. And it's right there. And that's one of the things that we're trying to get out to folks to say, look, there's tools that are created for you every single year that are available and let you know you're on track. But for you as employers, you also can look at the bigger picture to see, hey, are my folks generally on track? The rule of thumb is, if indeed you only have a pension plan, meaning this is every participant only have a pension plan, you're less than 50% likely to be on track at retirement age. 50%. Not guaranteed by any means, right? Now, the numbers increase to over 70% should they have a supplemental plan. I know. So that you can see that these plans really, really do make a difference. And that's one of the reasons, too, why they asked me to kind of be included in the total retirements discussion, because obviously these plans make the differences whether they're on track or not. All righty. So obviously, in terms of having money for the must-haves, healthcare is actually one of the first things. And of course, that even brings you back to discussion today. Health is probably the #1 indicator of success in retirement. People ask me all the time, is it money? I'm like, no, it's a plan and it's your health. We talked about where people are going to get their income in retirement, and obviously Social Security, their pension plan, and any of their savings as well. And it is a daunting task. You should see their faces when I ask them about pulling in income sources to kind of get themselves on track. Having those tools like the annual benefit statement or the MyNC retirement statement can be very, very helpful for them because it's already listed. If they look right on their report, it's got TSERS, it's got LGERS, it's got what necessarily their 401k would generate in monthly income. And it lets them know, hey, you're right on track to replace 80%. Alrighty. So here is probably something just to kind of maybe bring to your attention. Another misconception for most of our pre-retirees is how long they're going to be in retirement. How long they're going to be in retirement. Now, how long do you think you're going to be in retirement? What do you think? Yeah, easily. At least 20 years, right? If we live to 65, we're likely to get to 85, and that's kind of what this busy slide says. Think of it this way. My grandmothers on both sides of my family lived to mid to upper 90s. How cool is that, right? But it's scary cool, right? Because if I retire in my mid-60s, which is my goal, right? The answer is I could be 30 years in retirement, right? 30 years, if you think about it, you could spend 1/3 of your life in retirement. 30 years is the number that they ask to work for full benefit, right? So you could literally be in retirement as long as necessarily you've worked. It's an incredible thing. So the answer is, how do you have enough money for all of those years? Alrighty. I don't know about you. Of course, it's a younger crowd. As I get older, this inflation thing is really, really bothering me. I mean, it really is, in terms of just coming out of a store with just one bag of groceries, $50. It's ridiculous. It's $50. I mean, $50 used to be a lot of money. Nowadays, I talk to like niece or nephew, and they'll $50. And like, $50? That's not that much. I'm like, oh, okay, all right. I don't know about you, but I think I pay $3 for a loaf of bread now. I'm trying to get the gluten. Exactly right. It's exactly right. That's exactly right. So things are going to cost more in the future. Now, why do we say this? Living longer and things costing more in the future are the other reason to have this disposable money. Disposable meaning access to money on an as-needed basis. Already. Now, we are not going to talk about that. I mean, Doug did such a nice job in terms of overall, but I will show you, these are some numbers for TSERS. Now, of course, we're going back a couple of years. Average replacement value, less than 40%. Average replacement value. So you can see that their gap is going to increase if indeed there's not enough support there, right? I included elders as well, for our discussion today, just to make sure look, these are kind of just general numbers. Doesn't mean any one individual, but to kind of give you an idea about what the support is there. I do have, when we just talk about taking charge of retirement, I do want to tell you that there's a couple new tools out there for you. This was so cool. We actually had a team meeting just this past week, and we now have DocuSign as an available resource for enrollment. I know, how cool is that, right? It is something, and people, especially if you are looking at new hire orientations, right? And you're trying to get them maybe online, and your payroll system just will not give us all that indicative data, or there's just some kind of reason as to why you can't do that. With email addresses, a DocuSign custom form can be sent. Custom meaning it can include the subplan number. So easy. Two really, really easy reasons. One, obviously, it's in, it's out, that you're taking advantage of the interest at the time, right? You put too many obstacles in front of people, right? They might delay. I've had people delay years in terms of enrolling just because it's not an open enrollment process to get into the plans, right? They can do it at any time. So you know what that does? That puts it to the side, right? Hey, it's been decades for some folks. They never did get enrolled, and now they're trying to catch up, right? So DocuSign is something that's available to you. If indeed you're interested at all, reach out to your retirement education counselor. I am one of 18 people. The packet that you have for you does indeed have your contact people. So if you're not sure who your retirement education counselor is, know that you can always reach out, and it's listed by county, okay? So this is actually something to help you get set up. In terms of DocuSign, it's just an available resource. Hey, if you still use something where you hand something out to them, know that we've got the customized EZ forms, so it can actually have your stuff on there. And there's just one more thing I wanted to mention. And I'm sorry, webinar land, I really do wave my hands, and that's probably very irritating, so I'll try and stop doing that. The EZ form added, and actually even the enrollment form as well, added what was called a trusted contact. A trusted contact. So if you've not seen that before and you're thinking, what is that? This allows someone to put information on their enrollment form that allows us to talk to that individual, okay? And it's something certainly that's been very, very helpful as people get older. They might want to have us talk to somebody on their behalf. There's not changes that they can make, but we can at least talk to folks about that. So if indeed that wants to be added, it can certainly just be a call to customer service, but it'll notice on all the new forms, both easy as well as the long forms, trusted contact is added. So I didn't want you to be surprised by that. Investments, consolidating accounts, these are kinds of things that certainly can help overall. When you talk about purchasing service credits, when you talk about how do you increase pension benefits at retirement, the transfer benefit, having assets in the North Carolina plan certainly just gives them more flexibility in terms of overall. We were chatting just about increasing contributions regularly. I mean, do it on a regular basis. It's just something that really is adding up. I had a husband and wife yesterday, and the wife was actually just kind of tapping her husband saying, hey, this is all me, because she made him set up a 401k, made him put in $50 a pay. He never, ever missed it and almost forgot he had it. And yet tens of thousands of dollars in this account now. So it's the kind of thing where, you know, as soon as you get it set up, it takes a mind of its own, and we don't really miss it. We really don't. So paying ourselves first certainly has a value when you can see even at retirement, it's like, you know, I didn't even miss it. I'm like, I know, I wish you would have done more, you know, and that way they would have had more. Alrighty. Catch-up provisions. Have you heard of catch-up provisions before? It's kind of a funny thing in terms of catch-up, right? Because what really IRS has done is they looked at those individuals over the age of 50, and they basically said, we're a little concerned that you don't have enough money for all of your years in retirement. So we're going to let you catch up. Catch up as in, okay, you got to put more money in your plan is what they're saying, right? So they allow additional monies to go in if you're older, okay? The contribution cap does change each year, and this is voluntary contribution cap. This year, you guys know it's $19,000 can go into the plan. You could own both 401k and 457. 401k and 403b. Do we have any 403bers? 401k and 403b are very, very similar, and they would be a combined amount. You can own both plans, but combined between the two of them, $19,000 only for those two. But 457 and 401k, you can actually then have $19,000 in each plan and contribute max to each one. If you're over the age of 50, you can do $25,000 into each plan. Now, this does not come up very often, right? But it does come up really at retirement because there's final payouts, right? Unused vacation, bonus, longevity if eligible, right? And so some of these can be sizable, right? And especially if they've been contributing in their plans, you know, throughout the year. So even if you don't remember the numbers, just know that there's only so much that can go in per calendar year, okay? And the catch-up just allows more to go in. Alrighty, we are not going to look at font size 2. This is just to let you know, these are some of the tools of it. I know, I mean, goodness gracious, right? So in terms of specifics for each plan, know that the tools that are available for you are really, like, I just want to make sure you feel comfortable, all the things that are out there. If you wanted printed, we can do that. If indeed and like this is kind of like a highlight type of sheet, right? If you wanted something, and I think this is the coolest thing ever for employers, we have a flyer that actually takes all 3 plans and compares it side by side. Because somebody's going to say to you, well, why do you have 2 plans? You know, why do I have 2 plans? Why? And this is there's 457. 403b is for K through 12 and community colleges only. But why do we have 2 plans? Well, there really is some differences between the 2 plans. There's many, many similarities, but there are some differences in the plans. You have to be a full-time contributing member to the pension plan to contribute to 401k. Okay, full-time contributing member. So that's permanent full-time folks. They've got to put their 6% in, and they have access to 401k. Now, contrast that to 457, anybody receiving W-2 income. So this is people, and I talked to our folks even here, this is people that even work with Temp Solutions, you know, so part-timers, return to work retirees, anybody receiving W-2 income can participate in the 457. So know that there's some differences of eligibility, like who can do that. Now, can full-timers contribute to 457? They absolutely can. They absolutely can. So they actually have options to both, right? But just your part-timers have only access to the 457. Employer contributions, you know, if money actually goes in on from an employer perspective, there are indeed some rules about necessarily does that affect how much can go in. Catch-up provisions are designed to be able to allow people to put more money in. I'll tell you, as I get to my age and webinar land, I guess you can see me, I'm getting close to retirement. And so with a lot of family responsibilities behind me, husband and I feel like we're working for retirement now. We're kind of just trying to get everything locked in, make sure that we're all set. Loans, hardship. Now, this kind of brings us back to our discussion today. And this is where really, you know, talking to folks that are on kind of a disability, think about it this way. They're considered actively employed, and yet they're not getting any wages, right? So there's not a way for them to take out a loan. There's not a way. They're not separated service. They may indeed qualify for hardship. They may qualify for hardship. So hardship just says there's certain IRS rules that will allow you to take out retirement money for non-retirement reasons. And in our discussion, many times that might be medical bills, in terms of those kinds of things. Do know that there are exemptions to the 10% penalty. And that's just listed on the IRS website. And there's a whole list now. So if indeed they have a 401k and maybe they're too young to take out retirement money, know that there are exemptions on that penalty. Withdrawals while working. So if you're considered actively employed, right, then, and necessarily hardship is your only option for withdrawal, the only other option is if you're old enough. And that is in-service withdrawal for 401k is 59 and a half. 59 and a half. So I guess IRS just said, hey, as long as we're this old, you can go ahead and take out money even while you're still working. Okay. 70 and a half, contrast that to 70 and a half for 457. So are there people still working at 70 and a half? I will tell you, we've got folks here. Early withdrawal tax penalty. Now this is actually an important piece as well, because when you think about it, 401k and 403b are tied to a certain age. Do you know what the age is when you separate service? So now we're separating service. Do you know what the age is for 401k to avoid a penalty? How old do you have to be when you separate service to take out 401k money? We love 59 and a half. 59, the answer was 59 and a half. We love that as a number. Any other numbers? As long, I'm sorry? Yes! Okay, so as long as you separate service, okay, now when I say separate service, that means government service. And so for webinar land, just know that if you have someone that's working with you now and they go to another entity, whether that be state or local, that is not separating service. So you're with me as to why I point this out, right? Separating service is the trigger to allow access to retirement money, whether that be penaltied or not penaltied. So if you're not separated service, then they would not have access to withdraw. All right, you're with me on that one. So separated service, as long as you are in the year you turn age 55. 55. So even if necessarily you're retiring in January, your birthday's in December, as long as you're going to be 55 that year, absolutely fine to withdraw money. Absolutely fine. Separate service in the year you turn age 55. If indeed, and I don't necessarily know we have them here today, law enforcement officers, EMS, and fire folks, the law changed for you all back in 2016. Do you know what age they have to separate service? Yeah, yay! 50 is the answer. So separate service in the year they turn age 50 or older. Okay, these are minimums now, or older. Okay, now we have people all the time, 30 years of service. Teachers is a good example, right? They just get out of school, they're teachers, they got 30 years of service, they're like 51, 52, young, another whole career. But they didn't separate service at 55, right? So then they, in order to avoid a penalty, will have to wait until 59 and a half. So if you separate service before that, then 59 and a half is that rule. Are you with me there? I know. Now look, I'll tell you, as you get older, we don't want you to take out money when you're young and you can work, right? In terms of overall, but it is an important thing to know, even if necessarily we don't always know the specifics, that there are things tied, right? I mean, when we talk about eligibilities or access and those kinds of things. So long-term, short-term disability, they're still considered actively employed. They are not separated service. They are then limited then to those within really, truly the hardship situation. Are you with me on that? I know it's a hard discussion. Now, once they separate service, obviously that's a trigger for them, okay? That's a trigger in terms of access. In terms of actually the benefits for saving, we talked about trying to get some of the new hires in terms of what are the benefits for them. Obviously, the taxable benefits can be huge, right? It reduces taxable income now. It costs them less money today. I can't make it any bigger. I know. Money that goes in now, we talked about small amounts of money really add up in terms of overall. And so this is just an idea of pre-tax contributions. And the same thing with Roth. Roth contributions are money that come out of your net pay and they grow tax-free forever. So there's two types of ways to put money in the plan. One helps you tax-wise today, one helps you tax-wise later. Pre-tax helps you now because it reduces taxable income now. But down the road, okay, 10 years, 20 years, 30 years down the road, all that's sitting over there doing its stuff. When you start pulling it out, will it be taxed then? Yeah. It will. It will. Just know tax help now doesn't mean tax free. It just means tax deferred. Okay, tax deferred. Deferred as ordinary income when they retire. Okay, already. So taxable events, we don't give legal tax advice, but you can see where having a tax professional can be helpful for retirees or even individuals that are looking to withdraw large sums of money, right? How is that going to affect all of their taxable situation? Alrighty. Obviously, saving money in the plan is important. The kinds of tools that are available to you, everybody got a card from the communications director here. That's designed to kind of reach out to you to say, what tools do you need to help communicate stuff? What tools do you need to help necessarily not only the management, but the understanding of the plans? And that's certainly something we want to encourage you as well. The flyer that you have in your handouts, no, it's got my contact information as well as your dedicated person as well. And we're here to make sure that we support you too in terms of the kinds of things you need. Do you need somebody at new hire orientations? Do you need somebody really for retirement? We're starting to come and travel more in terms of actually going to locations at request. And that's Doug's area. I mean, just done a great job there. So the outreach is to try to make sure you have the tools you need. We know you're sitting in front of folks, right? What do you do? How do you invest? I mean, that we're trying to make sure that you know, look, you've got people and professionals to help, not only you, but your folks as well. Alrighty. I will tell you, and the only thing I'm going to comment on about investments is that out of sight can be out of mind. You know, they enrolled 10 and 20 years ago. They still have the same investments they have now. Goalmaker is the tool that's offered as investment help. And that's actually through the Board of Trustees, the Treasurer's Office, and they've got financial advisors that help to create these help, the help in the investment side. Most folks, when you poll the audience, know they need to save for retirement. They're just not usually really comfortable in terms of how, okay? So the Goalmaker is there for you too. What happens when you leave the job? You can keep the money in the plan. There's a misconception that you have to take all of your money out. Absolutely not. You absolutely do not. The advantage of keeping it in the state plans is really huge in that these plans are big. You have any idea how much money's in these plans? 401k, 457? Billions. Yeah, it is billions. It's over 10 billion. So what does that mean? Well, it's not any one individual's account. It's everybody's, right? It's everybody's. But the answer is that's a lot of negotiation power. It's not what you make in retirement, it's what you keep. So if you don't have to pay the fees, right, then the money actually might be better off there in terms of overall. Alrighty. Separating service is a trigger. Like I said, separating service is a trigger and allows people to roll the money over. A rollover just means you're not really using the money. You're actually just putting it somewhere else. Okay, so picture it, you know, like a rollover, just putting it somewhere else. You can put it into your new employer plan if you go somewhere else. Lots of folks travel within agency, right? So, hey, you were at revenue, but now you're here. Okay, it's the same plan. You just need to let us know. And there's actually change of employer form, you know, in terms of I'm looking for a different employer now. They can begin withdrawals. I mean, it's designed for that, right? Monthly, quarterly, as needed. Very, very easy. And then the transfer benefit. Transfer benefit says at retirement, I can take my 401k, my 457, and these are the state plans that are available, and actually have a separate income stream. So it creates a separate check. It's literally taking the assets that you've saved and annuitizing it. Okay? And you can have different options and things like that at retirement. I will tell you a good tool, and one of the things that I always have people kind of go to is go to Orbit, because the estimators are right there. Calculate my monthly benefit. I know, I love them too. I mean, estimators are there. Calculate my monthly benefits. How much does it cost for me to buy this time, or the service credit estimator? Those are the kinds of things that help them to kind of manage their accounts as well. Alrighty. Loans. You have the ability, when somebody takes a loan in their account, they're basically borrowing their money and then paying it back through payroll, right? Paying it back through payroll. When you have anyone that's on an approved leave, so that's approved by you, whatever your rules are, and you guys might have different rules in the room, right? If it's approved by you, you can send up a note to NC Plans and let us know to suspend the loan at this point, all right? So if it's an approved leave and they have an outstanding loan, it does not necessarily have to default. Alrighty, so you just let us know they're on, like, let's say, for example, military leave, or there's some kind of leave that you've approved, you can suspend those loans. Now, it will automatically restart after a year, but you let us know, okay? So that helps your members as well to know that you've got some help with that. for approved loans. Now, if people separate service with an outstanding loan, no, they can take it with them. They can take it with them. So all that means is they call Prudential and say, hey, I've separated service. And separated means retired, left, terminated. I've separated service, but I want to continue paying on the loan. And they basically then just repay it through a check. They write themselves a check and it's deposited in their accounts. So no, when forced in particularly in these kinds of situations, right, there may be outstanding loans that they had, previously. Default only means that they decided not to pay it back. Right? Default means, so it's not like a credit thing or anything like they just took money out of a retirement plan. Okay. And in these situations, when we talk about disability, if they have an outstanding loan and they don't necessarily pay it back, it will become a distributable event in that year. It'll be taxed as ordinary income. Now, the pickle for some is that loans, we presuppose loans are going to be paid back, right? So we withhold no taxes on these things, right? So depending on the size of the outstanding loan, that could really pinch in terms of a taxable thing because it's just added to ordinary income for the year. All righty? All right. So it also could necessarily affect a penalty if they're too young, unless they actually qualify for an exemption. All right. So that's one thing there. Obviously, the only other thing, and I see Doug standing, so the only other thing I wanted to mention was beneficiary. It's the only sad part of my job because I talk to people about their new lives. How cool, right? But beneficiary is something where the annual benefit statement checkpoint 4 lists all the beneficiaries, not only for the pension plan, but also then for the supplemental plans. If there's nothing in there, that means we don't have a beneficiary on file. All right. So anyone that's ever handled any kind of estate issues can sympathize to say that this is something that we do for our families. Sadly, if you don't get a chance to use the benefits you've accrued, your members have accrued, then the answer is, look, let's just make sure that it is indeed the people that you want to make sure that have that money. Okay, so beneficiaries are so important. They can go online. There's always a form, right? There's usually a form for that, right? But that's got to have to be notarized. So online is the easiest thing. Primary means member sadly has passed away. It can be a person, persons, or a trust. I had a grandpa fill in 10 persons, all 10 grandkids got 10% piece. So you can do anything you want, person, persons, or a trust. And there's also a secondary, meaning sadly you and primary are gone. There's a secondary. So you can make sure your folks know that assets they don't use, it's going to go to wherever they wish. Alrighty, so beneficiaries. And that's really it. Know that we are the other tools available in terms of obviously the retirement education counselors are here for assistance. Retirement income calculator. These are like on smartphones now. How cool is that? Because you and I both know we all have smartphones, right? Download the retirement income calculator. You can download the Prudential app, and actually with my finger, it gives me the hi Margaret. And I'm like, how cool is that, right? So the bio identifier, I don't have to do the PIN, and it will give you balances. The things that people are usually asking for on their phones. The retirement income calculator says, are you on track to replace that 80%? All right, and let you know the things that you might decide to change, how it's going to get you closer and closer to your goal. All righty. And of course, we talked about the annual benefit statement. The one-time contribution form. Do I just one more minute? Okay. The one-time contribution form, there is a misconception about one-time contribution, and it's our fault because we name it this, and which just means people are not really sure if one-time means one time for their lifetime, one time per calendar year. The one-time contribution form was designed to say, hey, for one payroll period, and for most of you, it's monthly. Some of you it's biweekly. For one payroll period, I want to do something different to my 401k, for example. So I'm putting in $100 a month, but for April, I get my longevity, so I'm going to throw in a couple $100 in that one April pay. And then in May, it goes right back to the $100. So one-time contribution says, hey, for the one payroll period, I want to go ahead and put something else in. For those of you on Beacon or Best Shared Services, it goes right to them. The one-time contribution form, when you have your own payroll department, it goes right back to central office or your HR folks. Many people will use this certainly as they start saving for retirement, as well as at retirement, because the unused vacation bonus and longevity are paid out in cash. Right? They can defer the taxes and give that little account a little push on its way out, right? In terms of overall. So one-time contribution form, it is indeed a form, but it's designed to kind of help people to kind of get a little bit more money in their accounts. So it's not something necessarily well-known, but it's something that is indeed available. Where do you find these? Of course, on the website, the ncplans.prudential.com site, ncplans.prudential. You're going to see the treasurer right there. All the forms are listed right there as well. You guys are right there at the top. You know, we got annual benefit statement and employer information. So if there's anything that we can do for you as well, access to plan sponsor, access to all of our reporting. If you're interested in your readiness numbers, let us know. Let us know how we can help you there. So I certainly want to thank you for coming and having me be here. Thanks, Webinar Land.
Thank you, Margaret. Well, that will conclude our meeting for today. I just wanted to announce we are finally doing certificates for employers that complete the Employer Online and Employer Training Program. However, you do need to attend all of them, either online or in person. There are 6 for teacher and state, 5 for local government, but we finally devised a way to track all of that, and once you get all 5 boxes checked, we'll send you a certificate signed by the treasurer. So that's your hopefully goal for today. So we'll sign all of you up or mark that you've indicated or indicate that you've attended today, and we'll start that process. We're actually going to roll that back to when this service or this series began. We're kind of halfway through a current rotating. About every 10 months, the program starts over again. So again, thank you. Have a wonderful day. And if you have any questions, feel free to give us a call or send in an email. We'll be happy to respond.